Okay, so as we dig into the market action right now, financials are holding up. JP Morgan is leading the charge, but it's got this halo effect on Goldman Sachs, even American Express contributing to gains on the Dow Jones Industrial Average, and pretty much everything else is down in the United States as there's further confirmation of economic deterioration south of the border, punctuated by retail sales this morning, which fell by about 1%. Let's bring in Brian Madden. He's Chief Investment Officer at First Avenue Investment Counsel. Brian, thanks so much for being with us.
Great to be here, Amber. Thank you.
Let's talk these U.S. banks. A lot of fear going into these numbers, and they managed to pull off a solid quarter by bouncing or leaning on certain sectors that worked, trading, for example.
Yeah, absolutely. It's fair to say that none of them were dreadful and none of them were sensational. And it was very much an idiosyncratic story across the banks. Some of them had expansion in margins, net interest margin. Some of them, as we had expected, had deteriorating credit provisions, notably Wells Fargo. Some of them, remarkably, like PNC Financial, a regional bank of all things, actually had a step down in credit provisioning. Right. Largely, though, I would say the theme is tepid growth when you look at the balance sheet. None of them grew loans, and the only one to really grow deposits was JP Morgan. And again, I would say we really expected that because we had this instance of somebody shouting fire in a crowded theater last month that tipped over two banks. And what do you do when you're worried about the safety of your deposits? You go to the granddaddy of them all, and there's no doubt that is Uncle Jamie at JP Morgan. And
Uncle Jamie must be thrilled with the stock price that we're seeing today. However, we had an analyst on this morning who said he'd fade that rally because of the underlying, guts of what we're seeing, a slowdown in lending. These banks are going to see things like higher deposit costs, which will compress their net interest margins, even though JP Morgan boosted their forecast for it. But I'll leave that aside. How are you thinking about ownership in this sector?
Yeah, great question, Amber. We've been in, broadly speaking, a bear market in U.S. stocks and, more severe in certain categories of stocks than others, obviously, for the last 15, 16 months. We don't own any of the U.S. banks at First Avenue Investment Counsel. We do own a number of the better Canadian ones. But yeah, we've had an interest rate cycle, and what invariably follows an interest rate cycle is a credit cycle. But much like everything else, as this sort of slowdown has been unfolding at glacial pace, the question is not if it's going to happen, it's when and how severe. And so we think probably not terribly severe, not like 2008. But the if, there's absolutely no question. And the when, we think it's going to be this year.
So why own some Canadian banks and not U.S. banks?
Well, Canadian banks and U.S. banks are just like night and day. For starters, let's address the elephant in the room, which is that Canadian banking is really a clubby oligopoly. You've got 6 banks that control 90% of the market. They're better regulated, they're better managed, and they're just stronger. And that's very evident when you look at measures of profitability like the return on shareholders' equity. And so they don't trade like cyclicals the way that U.S. banks do. They're a great growth and income combination and a stalwart and a core holding in a well-diversified Canadian portfolio. They don't go up every single year, but as a group, they have gone up and outperformed the TSX in something like 18 of the last 25 years.
Let's talk about the other elephant then within that group, which is TD, that has been ensnared in the issues in the United States. Is that an example of a name that you're looking to pick up on weakness?
100%. We own it. It's a big weight in a couple of our portfolios. We'd be adding to it. Obviously, as viewers will know, they're involved in a large transformational acquisition of First Horizon.
And do you like that deal? Do you want them to go through with it?
Well, let's roll the clock back. We loved it when we first heard about it. Things have changed. It's been stalled by regulation. We still like it. Strategically, it makes sense. Financially, it's going to be accretive. It's very synergistic. It expands their scale and their footprint in their region. So we'd like to see them do it. But we think, the imperative is for them to renegotiate the price. Right. They're likely hearing that from their shareholders. They are certainly hearing it loud and clear from analysts. And the market is screaming it from the rooftops in the form of the share price of First Horizons, which is trading at $17 or $18 versus the 25 they've offered. So, the next move is theirs, we think.
So it's interesting to contrast TD, which has certainly lagged, definitely in the past month, with, say, a Scotiabank, which has outperformed in part because it's not in the U.S. And for once, that's kind of working in its favor because it had issues in its other international market. You've got this new CEO. Is that a name you're also looking at for very different reasons? I'm just trying to get a sense of where are you picking your spots in the Canadian banks?
No, so we don't own Scotiabank, and we haven't owned it. It is enjoying a bit of a counter-trend move relative to the group because it's sort of keeping its head down and, cleaning up its own house. I won't belabor the whole sort of tale of succession and all that, but it's sort of shelter in a storm because the other banks are embroiled in pretty large-scale mergers and acquisitions and cross-border forays of various sorts. So it's sort of safe and quiet, but structurally we think that it is not as advantaged as some of the other banks are that have a big presence in the United States. The problem with Scotiabank is this promise of greater structural growth in emerging markets, particularly in LATAM, has never really made good on the promise. It has carried outsized volatility and cyclicality, but it hasn't really delivered on the structurally higher growth prospects.
Bank stocks, if we go into some kind of recession or slowdown, won't be immune. But to your point, you're kind of long-term. You're willing to put some selective names in the portfolio. What are you willing to put in the portfolio, I guess, to insulate against what could be some volatility on the back of that? Are you looking at gold? What role is that playing?
Absolutely. So, we're not just sort of fresh money on the gold trade. We've been involved for quite some time, crucially since last summer, which is around concurrent with the U.S. dollar peaking against the basket of other major currencies and gold bottoming. Gold is already setting fresh all-time highs in a number of major currencies that are buyers of gold, notably the Indian rupee, the Aussie dollar, the Japanese yen, the Great British pound. It hasn't yet made an all-time high in the world's reserve currency, the U.S. dollar. We think it will. And so we've got an overweight position in gold in several of the three equity funds that we manage. And we recently added a royalty name to one of those portfolios in the last couple of weeks.
Which one?
Osisko Royalties.